If you want to invest like the rich and wealthy, then watch today's video, because in today's video, I will go through the 5 main asset classes that your money goes through when investing. Okay, let's get into it. Hey, what's up you guys? Lukas here from excelwealth.com. Great that you joined in today, because in today's video, we will go through the 5 main asset classes that your money goes to the moment you're investing. Now, why do I say the main 5? Well, it's as simple as this. The moment you want to invest, just like the rich and wealthy, and always like Robert Kiyosaki tells us, hey, if you want to put your money at work, then you got to put them to work in an asset class. And in today's video, we will go through these 5 asset classes. The fun part is, of course, the moment you belong to the ultra wealthy, which is 30 million and up, then you go to a different level. Then you're in a complete different league. The moment you are an ultra wealthy person, then we're talking about different classes. But then we'll just go into that in a bit, okay? So we're talking about these 5 main asset classes because these 5, most likely, everybody will be investing in these 5 main classes. Okay, let's get into it. Now the first asset class is equity. Now what is equity? Equity is when we're talking about stocks and shares. So it's very simple. There are 2 kinds of stocks and shares that you can invest in. Now you can invest in stocks, for example, which is individual stocks or stocks within a fund. You can invest in individual stocks, for example, in Apple or in Tesla, but you can also invest in a certain fund. Then all of a sudden, there's a group of companies all put together in a portfolio, and one fund manager is taking care of those stocks in a group, of course. And then the moment you're investing with that fund, you're already diversifying your whole portfolio of stocks right away. So how do stocks actually work? It's very simple. You buy a certain stock, for example, for $100. This is what you bought the stock for. So what you actually get, you get like 1 million share of the company for that $100. We'll just pretend that, okay? And that for that $100, the moment the company is valued more in equity, so let's pretend that one share price all of a sudden goes to 110. And if you have 10 of these shares, all of a sudden you can make $100 the moment you sell off the shares that you own. And this is how you can make money in stocks. It's very simple as that. The moment you sell off a certain stock, that's the way how you make money. It's gaining money through equity. This is why it's called equity. So this asset class is called equity because you gain money the moment the company grows in equity as well. In the end, equity is just growth in the company and people valuing the company at a certain number, which is actually a bit weird because we could actually just say the company is now worth this amount, and we could all say the company is worth this amount, which is a little bit hard to understand sometimes. Now the other end within equity, of course, is dividend stock. So within a dividend stock, it's slightly different than an equity stock like this, because what they do is they give you back a little bit of money every time because you've invested with them, and they actually like you for that. And they say, you know what, thank you very much. For example, Coca-Cola says, hey, thank you very much for, investing your money with us. We'll give you 3.5% annually money back. So if you invest $1,000, you get $35 in a year back, and that's their thank you for believing in them. Now, it's very important the moment you want to buy stocks. Well, most local banks offer a brokerage account as well with them. So it's more like an investment account. So you have a checking account in which you have money coming in and you can pay bills for that. And on the other end, you've got a brokerage account, which is like an investment account. All the money that goes there, you can actually use to buy certain stocks and funds. For example, Robinhood is a very good example, or Vanguard is one. There are so many brokerage accounts out there that you can actually just use. And here in Europe, because I live in the Netherlands, here in Europe, we've got eToro, for example, or Plus 500, or the Giro. There are so many out there that you can use to buy funds and stocks. Let's go to the next one. Now the second main asset class is, of course, bonds. Not the James Bond, of course, but of course the bonds that we actually have when we loan money to, for example, the government, or we loan to a corporate company. There are two kinds of bonds. As you can see over here, we've got government bonds, and of course we've got corporate bonds. And it's very simple as that actually. What is a bond? A bond is actually just a loan. So you loan money to a certain project within the government or within a certain corporation. And what you do is you loan them money, and what they do is they pay you back the actual principal. So they pay you back the money that you loaned them. And of course, they pay you back a certain interest. And that's actually it. There's no equity growth in bonds. But the thing is with bonds, so because it's like a loan and the interest that they put on it, in most cases, they just pay you back in a certain set amount of time. For example, this could be 5 years or 10 years or 20 years. They just set the time like, hey, we're going to build a certain infrastructure project here in the neighborhood. And, if you want, you can actually just invest your money with us and we will give you back your actual initial investment. And of course, we will give you back a certain interest, which could be, for example, if you're a government, most of the time what you see is somewhere between 2 and 5%, which is more than, of course, what a bank gives you. But then the other end, it's not that much that you could say, wow, this is super impressive. With equity, you could get up to maybe 15, sometimes even 20%, which is, very good. But then again, the market in equity is very volatile. Whereas in bonds, it's, they're just paying off a loan. And if their creditworthiness is good, most likely they're going to pay you back. And the moment if they go bankrupt, if I say the government goes bankrupt, of course, the moment they do go bankrupt, the moment you owe a bond, they'll pay you back earlier compared to in equity. In equity, the moment the company goes bankrupt, you're the last one in line to get your money back. This is why bonds are very interesting the moment you're slightly older in age. You want to set your money aside, if you don't know how to do equity, of course. But the moment you own bonds, hey, getting a 5% return is still better than the inflation to beat. Because the inflation is already around 2% per year. So if your money is only making 2% as interest rate, you're just beating the inflation. It's like having a boat with an anchor down. It doesn't really go fast. So yes, but sometimes you see bonds that have yet 12% of an interest return, which is very interesting. But there's a reason to it, of course. These corporations or these governments don't really know if they can pay you back. So this is why they have to, move the balance up a little bit so that they will attract people to invest in their projects. The likeliness of your loan to be paid back is around 99%. Whereas the moment you go lower on the scale of creditworthiness, most likely, they might default and all of a sudden you can whistle towards your money. It's gone, like that. And this is asset class number 2. Let's go to number 3. Asset class number 3 is, as you can see on the board, is cash. Now I'll tell you this, cash is necessary. Everybody needs cash because you need cash to be able to buy things. So this is why you need cash. And cash equivalents, of course, the moment you don't use the money, you can park your money somewhere. And in most cases, what people tend to do, the moment you want to park your money, it's actually on a savings account. And a savings account on a bank, everybody kind of knows that there is like even less than 0.5% a year on interest, which is nothing. I think it's like 0.05%, which is like not even worth doing it because inflation is already 2%. You're just walking behind. You're even behind on inflation. Inflation is just beating you up like that, which is horrible. So this is why the moment you park your money, so for example, less than a year, that is called cash or cash equivalent. So you leave your money somewhere just for short term because you need your money right away. This is when you just leave in cash. Cash is good. And if you take a look in equity stocks, for example, if you take a look at that, you'll most likely see that in all the stocks and all the funds, you'll see that there's always cash in their portfolio as well. Why? Because, they need some purchasing power. Because if they don't have any cash, if a certain corporation doesn't have any cash, they can't even purchase things. So there is always money lying around. Maybe somewhat like 5%, but hey, that 5% can be used to purchase machinery, tools, any kinds of things that you need to purchase. Cash is what you need. I'll tell you this, cash is the worst return on investment. You have hardly any. So the moment you have cash lying around, it's like it's just evaporating. just like ice in the sun. It's just evaporating. You don't want that. You don't want cash lying around. Cash is just there for a short term, less than a year. If you're using the money within a year, cash is fine. The moment is longer than a year, try to find ways to invest it right away. Even if it's 2 years already, there are short ways to put your money away. CDs, for example, which stands for certificate of deposit. Just leave your money in for just a while and they give you, for example, like 2% on an annual basis. So, you're leaving your money in just to beat out the inflation, but you can take your money out right away if you want to. So this is why it's so important. Cash is important, but don't invest in cash. Cash, it's a horrible asset class. You don't want to stay in cash as much as possible. You want to invest the money, okay? Which is very important. Let's go to number 4. Now, number 4 main asset class is, of course, as you can see on the board, real estate. And I love real estate. And if you've watched more videos on my channel, of course, you know that you have to like this video. And next to liking the video, of course, you know that I love real estate. Because real estate is it's tangible. The moment you've accumulated some money, of course, you can actually invest your money in real estate. Now, why is real estate so interesting? There are multiple reasons why real estate is so interesting. So the first reason why real estate is so interesting is, of course, real estate grows in equity. Like, for example, you bought the property for $100,000 as an example, okay? And all of a sudden, after 10 years, this property is valued, for example, at $150,000. All of a sudden, in 10 years' time, you've grown 50%, just like that, from $100,000 to $150,000. Could you say that for all the other asset classes? No. So this is the interesting thing. Real estate grows in equity. That's one thing. Now, the second thing is the moment you own real estate, there's a method called buy, hold, and rent it out. And this is the interesting thing as well. You can actually just get rental income from your property every month next to the equity gain, which is super cool because you don't get any rental income from stocks or bonds or cash. You don't get that. This is the interesting thing. Real estate can get you monthly income. This is very interesting. But there's another bonus. It feels like a teleshopping TV show like this, like, and you're not getting this, and you're getting that, and you're getting that. Well, take a look at this. There's another thing within real estate. In real estate, you can use something called OPM, which is other people's money. You can leverage the money even with the bank. And this is the only asset class that the bank says, you know what? You're going to invest in real estate? Here, take some money from us. This is the cool part. You can use other people's money to buy real estate. And in this case, if you've watched more of my videos, if you know real estate, of course, you know that 30% is the down payment that you need to do from out of your pocket, next to 70% that you get as a loan from the bank, which is a great idea, of course. The bank would say, if the property is valued at $200,000, the bank just tells you, hey, mister, I need $60,000. I want to see $60,000 from your bank account, and I'll loan you the $140,000 to be able for you to buy the property. And at the same time, you get rental income, and the rental income should be enough to pay my mortgage off. And that's it. This is why the rich and wealthy buy real estate, because there's equity gain on the one end, there is rental income from the other end, and of course they can leverage their own money, which is a great idea because all of a sudden you don't have to use your own money like the first 3 asset classes. You don't have to use your own money to make money. Here you can use other people's money to make your own portfolio grow. This is why so many rich people buy real estate. And of course, we've got asset class number 5, as you can see here, and it's called alternatives. Now, alternatives, you might be thinking, well, that's like a general term of putting everything together. Yes, it is, because you can invest in, for example, precious metal, for example, like gold, silver, platinum, palladium. And of course, you can, invest in fine art or in exotic cars, because, if you buy an exotic car that there are only 700 of, build in the world, and if you have one and you leave it there for 50 years or so, yeah, people will kind of want to buy it. That's the cool part. So alternatives, you have to really be an expert in this to know which alternatives will make you money over time. Now, this is not something that I have very big knowledge over, so yeah, I'll just have to do with all the information I have as well, right? Okay, now, like I said, so these are the 5 main asset classes. Now, as you can see, you should see it like this as well. It's like a pie. Now, how much should you divide everything up? Now, they always say you should always have a slight bit in bonds. Well, I'm not really fond of bonds because bonds don't really do anything, but you know, you got to diversify your portfolio. A part goes into bonds. I always say almost half of your money should go into equity. Maybe somewhere between 5 and 10% should go into cash, of course. And maybe the other 40% goes into real estate. So my pie looks a bit like this. And yes, my pie may be not like, you know, completely correct. But my pie is about 40% is in stocks, about 40% is in real estate, and the remaining 5 to 10% is in cash, and the remaining part should go into bonds, but I haven't bought any bonds. I'll tell you this, I don't know if I still believe in bonds. I don't have any investment in bonds. I'm just being plain honest. I'm just being plain honest. So my money mainly goes into real estate and of course in equity and in cash. And this is how I divided my asset classes. Now, like I said at the beginning, of course, if you like the video, be sure to hit that like button. And of course, if you haven't subscribed yet. Now, like I said in the beginning, the moment you reach the ultra high net worth status, which is the moment you have more than 30 million, and most likely the moment if you have 30 million, you're not watching these videos. The moment you do reach that, so there are different asset classes for the ultra high net worth people. Those are derivatives, commodities, and hedge funds. But then again, you know, most likely when you're watching this, you're not ultra high net worth yet. But the moment you are, let me know down below in the comments if you've reached the status of ultra high net people. So hey, thank you very much for watching today's video. If you liked the video, of course, be sure to hit that like button. And of course, if you haven't subscribed to the channel yet, be sure to hit that subscribe button over there. And every time a new video comes out, be sure to hit that notification bell as well. Thank you very much for watching today's video, and I'll see you on the next time. Happy investing. Bye-bye.